Good evening. This is Professor Mayer, and this is our third chat session on controllership. We are going to be covering a more detailed discussion of the control of cash, short-term investments, and customer credit. We started a little bit of this information last session. It was kind of at the tail end of the session on internal controls, which we really was just trying to give an introduction here. We're going to cover this in a little bit more detail, and hopefully you'll find this to be some very interesting information. Cash is clearly important to an organization, and the ability to actually manage cash is going to be very important as an organization attempts to remain viable within their environment of paying bills and paying employees and all that kind of stuff. Okay, so very interesting information, and I'm looking forward to a good discussion. What we're talking about is cash and short-term investments, and let's go ahead and get into the material and see where we are. And again, some of the stuff we talked a little bit about last chat session. Some of it may be a repeat, but I think you'll find that it's going to be valuable information and a little bit over what we're trying to do in terms of, let's talk about this. So the issue becomes is we had a very good introduction to internal controls in our last chat session. Internal controls are very, very important, and clearly internal controls over cash become extremely important because cash clearly is the lifeblood of an organization. You need to understand where cash is coming from. You need to understand when cash is getting to you in time, and we need to understand where cash goes, and we need to have the controls in place to prevent these bad things from happening over cash. And there's a lot of bad things that can happen with your cash, and you want to make sure that these controls are actually functioning appropriately. The objective of a cash control system is we want to ensure that we have adequate cash both on a short-term basis as well as a long-term basis. Generally speaking, what we're doing in this regard is to maintaining a operating cash budget. We're also managing a capital cash budget. So when we think about long-term, we're clearly going to be thinking about capital expenditures. We also want to think in terms of, as an example, if we have a bond and that bond is where we're paying interest only, and at the end of the period we have to pay back the bond, the issue becomes is we have to figure out a way to make sure that there's adequate cash to pay back the bond. Maybe we're hoping to refinance. That may or may not be viable depending upon the credit situation. So we need to think in terms of long-term related to capital and make sure that we have these reserve funds and these other things in place to accommodate these future activities. We want to understand the effective usage of cash and establish accountability for cash receipts, ensure disbursements are approved for legitimate purposes, ensure adequate bank balances to support bank relationships, and ensure maintenance of adequate control records. Now let's talk about a couple of these things and make sure that we understand how important these are. Accountability over cash receipts. We talked about this a little bit last time in regards to internal controls, but what we need to understand is that there should be very specific internal controls over our cash receipts. These internal controls need to be established in such a way that when cash comes in, that there is a record of that cash coming in, that we're posting that cash to the appropriate accounts. But even before we post it to the appropriate account, we identify that we have cash and we get it into the bank as soon as possible. We're going to put this money into a reserve fund, or what we call an unapplied cash account. And then from this unapplied cash account, we're going to apply that to the appropriate accounts. The reason we want to put it into an unapplied cash account is the Treasury function, whether it's a different department or part of what the controller is doing, number one priority is get the cash, get it in the bank. Then we'll figure out where the bank belongs or where the cash belongs, but the first thing we want to do is want to get it into the bank. So there should be an expedited process to get this cash into the bank. We also want to think in terms of controls over not necessarily checks, but the day-to-day cash operations. Maybe we're doing cash transactions through a cash register. Maybe we need to have petty cash accounts throughout the facility. Whatever the case may be, is we need to have specific controls over the cash and cash receipts. Disbursements need to be approved for legitimate purposes, and these disbursements should be going through accounts payable. And through the course of this course, and we talk about it in auditing as well as internal auditing, is we need to establish some very specific controls over the purchasing function. The controls over the purchasing function includes things like determining how you create purchase requisitions, making sure that the purchasing department is the only one that actually creates an order, making sure that any merchandise then is received through receiving, which is a separate department, and then finally what accounts payable pays is able to match with the receiving and the purchase order, and they're matching that with the invoice. So there's very specific controls related to this disbursement cycle. We also need to make sure that there's legitimate purposes. Now, the reason I bring this up related to the controls over the purchasing function is it's very possible, in fact probable, that the controller is going to have significant oversight, clearly over accounts payable, probably over the purchasing function. So the controller really needs to think about this from the perspective of establishing appropriate controls. Now, it's interesting that we say ensure adequate bank balances to support bank relationships. I am the treasurer in our co-op that we live here in Manhattan, and the co-op has a mortgage with a bank, and it's separate from the loans that the individual shareholders or apartment owners have. But the interesting thing about this loan is the fact that the loan agreement stipulates that we maintain a cash balance in the bank of $50,000. Okay, so that's a restriction that we have, that we need to keep that money there. We need to make sure that we're not actually touching that money and doing other things with it. We also keep in mind that the bank is really a part of a relationship. So we want to kind of think about the banks that we deal with. We want to make sure that we're not dealing with a whole bunch of different banks when in fact maybe one bank or two or whatever may in fact be able to accommodate most of our needs. And if we can sustain ourselves in terms of adequate bank balances, we then have a greater probability that we're going to have a good banking relationship, and we're going to have a significant ability to interact with them on many different levels. I was working for a hospital group, and we actually had a banking relationship with SunTrust. And basically, even though there were multiple accounts within the SunTrust within portfolio, all of those accounts rolled up basically into one. Now what they did is they paid an interest on all of our balances no matter where they were. This created a responsibility for us in terms of making sure that we understood where all those accounts were, that we needed to make sure that there were no rogue accounts that were set up by different departments or whatever. So there is a management involved in terms of these banks. The other thing, and I'll just kind of throw this out to you, is if we have a bank balance, we have a banking relationship, make sure that the signature cards remain up to date. Generally speaking, it's going to be the controller, the CFO, maybe the accounting manager have signatory approval on these accounts. maybe different departments may have different signatories. As people come and go within the organization, make sure that there's a control in process so that as people leave, that they have signatory ability on a bank account, that we actually remove their names and we get new names in there. And frankly, that is just one of the many things that we need to maintain as we're maintaining these bank relationships. Treasury responsibility, custody of cash funds, as I had mentioned, is generally speaking, in an organization that's large enough, is the treasurer is a separate function from the financial officer perspective. So the treasury is responsible for the funds, is responsible for administering the bank accounts, maintaining the relationships, investing excess cash. Their primary responsibility is for cash receipts, cash disbursements. Treasury, as an example, would be the only person that could write off an accounts receivable. It could be initiated, or probably be initiated by the finance department, but the treasurer is that ultimate person that's going to sign off on that. So again, in an organization that's large enough, we generally see the treasury as a separate function in regards to, or as compared to, the finance. Finance is the functionality in terms of accounts receivable, accounts payable, and all these other elements, maybe payroll, that come together. But in terms of the actual disbursement and the actual cash collections and cash receipts, that's going to be the treasury. As an example, what we talk about accounts payable. Accounts payable only approves for payment an invoice. That payment approval then goes to the Treasury Department, where they then disperse the funds. So very distinct function. And I remember talking to a treasurer as one of the audits that I was doing. And basically she was saying, listen, what my goal is at the end of the day is every penny that's there in checks and otherwise get into the bank. We're going to worry about where that money belongs to and so forth after it's in the bank. But once it's in the bank, it then gets into this holding area that we call unapplied cash, and then the finance department is going in and plucking out those amounts and then pushing them over to accounts receivable, pay off accounts receivable, and so forth. So that's the distinction in terms of these functions. Controller's responsibility, cash forecasts, review procedures concerning cash receipts, and the disbursements. So as we were talking about, Treasury is actually paying an approved invoice, and on the front end collecting cash. What the controller is doing is the controller is actually managing it from the perspective of making sure that the cash that's coming in is related to specific accounts receivable, so you can complete the transaction. And again, at the back end, when accounts payable generates or reviews an invoice, accounts payable is essentially approving that invoice for payment, which is part of the function related to the controller. And reconciliation. So even though the treasurer is responsible for the bank, you notice how we have this segregation of duties. The controller is doing the reconciliation. As an auditor, we want to make sure that those reconciliations are done, and we also want to make sure that those reconciliations are done on a very timely basis. One of the worst things to have happen is, as a controller, you come in, you say, do you reconcile your bank statements? And they say, oh yeah, here's all our reconciliations. But then you notice that all 12 months of the reconciliations were done 3 weeks prior to the auditor's visit. No, that's not a good control. The control is you do the reconciliation immediately after receiving the bank statement, so then you can identify any issues. Cash forecasting, determine if and when financing will be needed, determine if and when past financing can be repaid, the controller is going to be the person that says, you know what, we probably should pay down some of these loans, or we should not pay down these loans but then request additional financing. So the controller is really making these determinations based upon these forecasts to determine when we need cash, when this cash should be available, and how we can actually repay this, estimating cash receipts and cash disbursements. So we'll give an example here, but I just want to point one of the things out that I'll give you a perfect example of this is, again, back to my treasurer role, and basically in the co-op is I'm the treasurer on the board of directors and really help facilitate a number of decisions related to internal controls as well as some financing issues. So several years ago, when we refinanced the overall building structure, one of the things that I was insistent upon is that we borrow more money than we actually needed, $1 million more than we actually need, and then hold that money there as part of our capital funding. At the time, it didn't really matter that we didn't necessarily have very specific projects, but in fact, over the years, what we've had is we've had to do a lot of facade work on the outside of the building. We're now replacing the elevators. So we've essentially generated over $1 million in capital expenditures. But because we made the decision beforehand to have that money there, we were able to do this and not have any of it impact maintenance increases or having a special assessment, which can be very, very problematic. Shareholders don't like to see that kind of thing. So that's the issue. The issue is you're going to forecast, and when you start forecasting well beyond the next year or two, you want to think about this in terms of what are the big capital projects. And we kind of knew what these big capital projects were, and we planned for these based upon the financing that we did. So I think ultimately we made the correct decision, but the reason that we made this correct decision is because we were projecting ourselves beyond just the immediate. We actually went through this last time, and I spent some time in Excel in like 2 or 3 minutes. It's kind of a fun little exercise. Let's just talk about this from this perspective. I made this point the last time, and I'll make it again because it's extremely important. The issue becomes is when we have sales comes in when it comes in. You see here, some 20% of the sales is cash, 80% is credit. Credit sales sort of meanders through a 3-month cycle, and you notice here that 25 plus 50 plus 22% doesn't equal 100%, which means that we're not ever going to get paid everything. So we're going to have bad debt. But the bottom line is if we're getting cash in 45 days, we are extremely happy. If we're getting cash within 60 days, we're probably pretty happy. But the issue becomes is we have to pay our bills like right away. Payroll, which is a significant portion of our bills, people want paid every 2 weeks, and they really want paid every 2 weeks. They're not likely, your employees are not likely to say, you know what, it's okay if you can't pay me next week, just catch me whenever you. If you've ever worked for an organization that didn't have payroll, it's pretty frightening. So you got to make payroll. But cash is not coming in as fast as it's going out. So therefore, we need to have projections. We need to understand when the cash is coming in and then accommodate the differences in a number of different ways. Okay, so here's what we've got. Sales is 20% cash, 80% credit. Credit is collected 25% in the month of the sales, 50% 1 month later, and 22% 2 months later. And what we have is we have sales $100,000 in January, $125,000 in February, $120,000 in March, and $150,000 in April. So what are the estimated cash receipts that we have in April? What we want to do here is consider this from just a simple table. And this is our table that we have over here for some of the earlier months, because we would need to know what the November, December, and so forth are. But what we have here is we have our sales, 100,000, 125, 120, and 150 for April. Credit sales is 80% of that. And of the credit sales, what we have is 25% is collected in the first month. So we have 25% highlight here. So this is 25% of the $80,000. This is 25% of the $100,000, and so forth. So you get the idea. 1 month later is 50% the prior month. So 50% of $80,000 is paid in February, and 50% of the $100,000 is paid in March, and then 50% of March is paid in April. And then what we have is we have 2 months later. So 22% of $80,000 is $17,600, and 22% of $100,000 is $22,000. So what this means, cash is 20%, so that's going to be collected in the month of the sales. Just kind of looking at this is you notice that we have $130,000 in cash collected in April as compared to the $150,000 in sales, and the other relevant month, which is March, is we have $115,600 collected when in fact we have sales of $120,000. So what's the takeaway on this? Well, the takeaway on this is the fact that in general, the cash collected is going to be less than our sales. This needs to be accounted for as we are working through our transactions, because it's clear that what we want to do. So we've got to accommodate this. The issue becomes is we don't necessarily know what's going to take place, but we do know as a general rule is that we are not going to get paid as much as our sales. The example, at the end of the day, we are getting cash that's less than our actual sales, and we need to understand that. But all of our payments we got to pay. Cash disbursements would be forecasted similarly using expected purchases and paying patterns. A organization, and I'll just make a point here, is an organization needs to establish a policy in regards to payment. And generally speaking, the payment structure is going to be 30 days end of month, or 60 days end of month. And what we mean by that is whenever we get a bill, it's 30 days end of month. The idea is that when we get our bill, is we process it, we approve it for payment. Let's say we approve it for payment for January 15th, on January 15th. We then schedule that 30 days later plus the end of month. So we would schedule that payment to be February 28th, end of February. So anything that we would approve in January, we would hold off and pay the end of February. Anything that we approve for payment in February, we would hold off and make the payment at the end of March. So we're always accounting for the fact that we're getting the bills paid, but we're paying these not right away because, again, we need that float. And a policy like this helps an organization manage their cash. So just like we manage our cash from the perspective of looking at our cash receipts, we would also look at our cash disbursements and understanding that if we're making all these payments at the end of month, well, what does that do? That actually creates an efficiency because then we have only one check run every month. It also pushes it back to the end of the month, so we are within that month period, within the month, so we know that we're going to make that disbursement in February, so we can plan on it, so we know that everything that is approved in January is then going to get paid at the end of February, so we know that, so we can plan on it. So we have a whole month, the whole month of February, to plan for the fact that we have outstanding payments at the end of February of a specific amount. This helps with our planning. And as we're going through our cash receipts and we know what our sales are, we know what our deficit is going to be, and then we're going to have to accommodate any deficits that we have accordingly. The cash float, we love the float, the time between a check being released to payee and clearing the bank. The organizations will go to excessive lengths to increase the float. So they may, and doesn't necessarily happen so much now because of electronic banking, but what companies used to do is they used to get an outpost somewhere in the middle of nowhere to print these checks. They would mail them out, and so there was a documentation that yes, it was mailed before the end of the month, and it had January 27th date on it, but the idea is that it wouldn't actually get to the intended user for an extra couple of days, simply because the checks were being mailed in some small town in Nebraska. Again, the float sort of clearly goes away with electronic banking, but a lot of companies actually resist paying electronically. A lot of companies resist paying electronically because we like the float. The float gives you that extra couple of days in terms of what we're trying to do. So we got the mail float, processing float, and availability float, clearing. So the idea is that now the bank then gets this check. Well, the vendor has to process it through their banks, then it goes through a clearing, and then it goes to our bank. So it's great when these are small banks kind of in the middle of nowhere that gives us some extra time in terms of this float. We shouldn't be playing the float, but what the float does is it gives us a few extra days in terms of collecting interest on this money as we are awaiting payment. Now, you notice this processing float. I'll tell you a very interesting story, and I may have told you this story before, but I was working for an organization that actually was having some significant cash flow problems. And the organization will remain nameless, but basically, actually I've worked with a couple organizations like this, is the checks were, or the accounts payable would approve for payment, the check run would be completed, so the accounting system essentially reflected the fact that everything was paid. But essentially what would happen is all those checks would then go to the controller's desk, and she or he, it's actually one place it was a he, the other place it was a she, it would then mail these checks based upon the availability of cash. Well, it created just a havoc because vendors were calling up the purchasing department saying, where's my check? And they would go into the system and they say, well, we clearly says here we mailed you a check on June 21st, because that's when the check run was actually completed. Unbeknownst to the purchasing manager, is those checks were actually sitting on the controller's desk. Certainly was not an appropriate behavior, but given the facts and circumstances, the controller had to do what in this case what she had to do to keep enough money in the bank to make payroll. So that's how difficult things were towards the end. Strategies to accelerate cash. Lockboxes. We talked a little bit about lockboxes the last time. Basically, lockboxes are a relationship that you have with the bank, and when people make a check payment, the payment is made not to the organization, but to a P.O. box, which is actually a lockbox at the bank. The lockbox then creates a scenario where the bank immediately deposits that money, and basically what they're doing is they're depositing the money, they're scanning the front and the back of the check, and then that that file of all these checks coming in, and then any other documentation related to the check as it comes in, all that then is scanned and then sent over to the organization. And if it's done correctly, then maybe 90 to 95% of those checks can then be electronically passed over to accounts receivable and automatically uploaded. Then you always have a few checks that don't quite match, and you got to figure out what they are, and you go from there. And the relationship that we have with the bank essentially should be where we have this technology embedded in the relationship that we call positive payment. So the positive payment basically means that when we, as the organization, do a check run, and the check run, we're assuming everything is fine, we do the check run, the checks get mailed out, and the check run, the file for the check run is then given to the bank. So when the bank now gets a check for payment, so they process a check, is they have the check number and the amount and the payee and the date, and those three elements are matched before the bank actually accepts payment. And what this does is that if there are in fact any fraudulent activities, is this generally is going to be caught, assuming that the bank is actually doing their job. We had two checks that I'm convinced that were sort of confiscated by a third party, which could not have happened within the organization. But basically what happened is two checks, we're talking $50,000, $60,000 in terms of the check amounts. When they came back for payment, the payee had been changed. And basically someone went in there and changed the name and tried to process the check. Well, because we had this positive payment, is the bank matched the check number to the amount and the payee, and given the fact that the payee was different, is they actually rejected the check. We did some investigation on that. We got, the FBI, as much as you can get them involved with it, and never able to figure out what took place. But whoever did it did a very good job in terms of changing the name of the payee. But because we had that extra security related to positive payment, it went through very easily. Or it did not, let's say it did not go through, and it was actually caught very easily because of this positive payment. To accelerated cash is Lockboxes gets the money in the bank faster. Concentrated banking, meaning just working with a single bank, really enhances our ability to control cash. Electronic payments, if we accept electronic payments, we get the cash faster. If we use electronic payments to pay bills, the check goes out faster. So what we would prefer to get all of our payments electronically, and then to make our check payments manually. Doesn't always happen, but that would be clearly the goal in terms of accelerating cash, as well as accelerating the float or increasing the float. More restrictive credit terms. As an organization decides how they're going to grow, one of the things they need to determine is what are their credit terms going to be. And the reason this becomes important is because the credit terms essentially define the probability of getting paid, as well as the timeliness of getting paid. So the idea is that if we have very loose credit terms, we're going to sell to people that we would not otherwise sell to. Unfortunately, many of those people aren't going to pay their bill. I've always said is that the easiest way to increase sales is by selling to people that never are going to pay you, because they'll buy anything because they're not going to pay you. The more restrictive credit terms, what that means is the only people that we're going to sell to are going to be those people that have an increased probability of making payment. The issue becomes is how do we actually match and get that sort of perfect fit in terms of credit terms that are high enough that increases the probability of getting paid, but loose enough so that we're not deterring good customers from actually buying from us. And that you sort of have to play with that number to get the right amount. Offering discounts, we're talking about discounts in terms of early payment. You've heard the term 2/10, N30. What this means is if you pay within 10 days, you get a 2% discount. Otherwise, it's going to be due in 30 days. The last piece is pledging or factoring receivables. It's very common for organizations to actually sell their accounts receivable, and we call this factoring. So you're getting your payment up front. Accounts receivable, you're still responsible for making sure that you're actually collecting, but the money as it's being received is actually going to this third party. This actually works very well for organizations that are really trying to get started, and getting money fast is actually more important than the amount of fees that would be considered as part of the factoring related to selling these accounts receivable. No credit, cash sales only. See a lot of small stock shops do this. No credit sales basically means you're not using credit cards, cash only, and there's some reasons why you'd want to do this, but again, no credit card, you clearly are going to be restrictive in terms of who you're going to sell to, or no credit cards or no credit is you're losing some customers, but sometimes it's worth it. Delaying negotiating with suppliers, again, a large organization may say is that if you want to do business with us, our terms are 60 days end of month, which means I worked for a very large hospital network, and that was their terms, 60 days end of month. People would complain, they say, well, I need my money faster, and our response to that was, take it or leave it. If you don't want it, we'll find somebody else. That's never going to be a problem for us. You will get paid, but these are our terms. And if you negotiate these terms up front, nobody's going to be, it's not going to be a problem. Ethical and legal questions, relationship with suppliers, and bounced checks. Well, we don't want to have any bounced checks. I've actually had a paycheck one time that bounced, which is kind of not a good thing for anybody. And I'm sure everybody has bounced a check once or twice in their life. Sometimes it's just a timing issue and so forth, but the domino effect in terms of a bounce check is highly problematic. Lines of credit. A lot of times we will establish a line of credit with a bank that basically says, we're not planning on using this, but we can at any given point borrow money for a certain amount and for an as-needed basis. Access to cash without incurring interest expense, flexibility, contingencies. Because again, you plan and you plan and you plan, but the idea is that one day something really, really bad may happen that was not in any of your projections, and you need money. So if you need money, if you plan in advance, you have that flexibility, that's actually a good thing. Any of these lines of credits are going to be disclosed in the management discussion and analysis. And in fact, in our financial statements, we actually disclose the fact that we have a line of credit. We also disclose that we've never used it and we're not planning to use it. I'm not going to go through this. This is just some notes that you might see in a financial statement, basically saying that we're in compliance with all loan agreements. And a couple of ratios that we want to talk about. Sufficiency. Do we have enough cash? Are we using cash efficiently? So sufficiency. Now you notice CFO is cash flow from operations divided by funds used for debt payments, asset purchases, and dividend payments. So what we're looking for here is do we have sufficient cash to pay for these items? And keep in mind that cash flow from operations is what's left over after we paid our bills based upon the core function that we have. If we consider that amount, that first component of the statement of cash flow, and compare that to all of our other payments, debt payments, asset payments, dividend payment, we're going to get an idea in terms of sufficiency. Long-term debt payments divided by our cash flow from financing, long-term debt payments, all these other things. Asset purchases would be cash flow from investing, cash flow from financing. Most of these other things are going to show up there. So it's very important that as you consider the statement of cash flow that you're also considering these other items. Dividend payout, dividends divided by the cash flow from operations, asset purchase divided by cash flow from operations, total debt, cash flow from operations, depreciation divided by cash flow from operations. Depreciation and amortization are non-cash transactions, so comparing this to our cash flow from operations, we get a sense of how much of our operations are essentially related to these items. And again, why is this important? Well, depreciation represents the fact that we have an asset that has a useful life that goes for several years, but ultimately will need to be replaced. Cash flow to sales. Looking at cash flow, and just kind of think about this, is if we're looking at our income ratio, income to sales, so income divided by sales, cash flow from operations essentially is, we're looking at the same basic concept of income, but we're looking at it from the perspective of how much cash we're receiving. So cash flow to sales is a very logical number that we would consider. It understands the fact that we actually are getting cash, and also this cash flow from operations is going to come from sales. So this is the thing that's going to be driving this. Cash flow to income, because net income includes depreciation expenses that lowers net income. So cash flow from total assets, again, what we're looking at in each of these elements is we're trying to figure out where cash is coming from and where it's going. So comparing this in terms of efficiency is we're trying to determine if in fact we're using our assets appropriately. Now, the point that we want to make related to most of these ratios is the fact that in and of themselves they may or may not create value. But what they become important, or why they become important, is we're able to compare these from year to year, and we're able to compare these to from our organization as compared to other organizations. Okay, so that's really the issue related to these efficiency ratios. As we're continuing on here, some of the stuff we've actually talked about already. Responsibilities. This really has to do with our segregation of duties. So there's very specific functions that people need to have, and these need to be separated from the other functions. So we've talked about the functions specifically related to cash in the Treasury Department and the Finance Department. We've talked about the separating of duties between accounts payable, which approves for payment, and the actual cash disbursement. We've talked about using the bank as a control function in terms of using these lockboxes. All these things become important, and what we're really talking about is this whole segregation of duties. Handling of cash separate from the maintenance of record, exactly what we've described specifically between the distinction between Treasury as well as finance. Cashiers have their own cash drawer. If you ever go to a grocery store, I'm sure you do, but you notice how the cashier, when she or he leaves, the cashier they're taking the cash drawer with them. So there is an assigned responsibility of the cash drawer. So essentially, they're doing this several times during the shift. They're not waiting to the end of the shift. They count the money before they start the day. They then collect the money and then they count it at the end, and they compare that to the receipts. And what's taking place is that there's other people that are signing off on this. So this person is responsible for their cash drawer. And that's really the function that we're doing in terms of cash. We bond employees with cash responsibilities. And bank reconciliations, we've talked about that. We've actually talked about pre-numbered documentation. We're recording all transactions, 2 signatures on large checks. I think we've actually talked about most of these things, keeping checks in check signing machines under lock and key, and marking supporting documentation as paid once it's made. The worst thing in the world to have happen is that we actually pay an invoice twice or more than twice. So we want to cancel the documentation in such a way that we can't repay an invoice. And the problem is that vendors are going to continue to send the invoices because they want to get paid. Well, accounts payable is getting all these invoices, and it can be quite confusing to determine if in fact this item has been paid. So embedded within the system should be a mechanism for determining that in fact only things get paid once. Paying is good. Paying it more than once is not a good thing. The other thing, and it actually surprises me to find out that this actually takes place, is bogus companies will send you official looking invoices. Why are they doing that? Well, they're doing it, the kind of phishing like anything else, is they're trying to get paid. Well, if a company has poor controls over their cash disbursement, very possible that some of these actually may get paid. So you need to be aware that there's bad people out there that are very interested in taking your money. Short-term funds, we're interested in principal, we're interested in stability, we're interested in liquidity. Short-term essentially is these day-to-day funds. Maybe we're looking for 5 days, 7 days, whatever the case may be. We're just going to get that extra ounce of additional funding in terms of investing, but we don't want to put any of the principal at risk. We don't want to, the principal should not fluctuate, and we are really looking for liquidity. We're looking for short-term marketability, short-term maturity, and we're looking for returns. We've talked about the controls over accounts receivable in terms of credit policies. Why do people pay late? Frankly, because they can. They don't like to pay their bills. Okay, so you always need to be aware that not everybody wants to pay their bills. So we need to have metrics, controls. So metrics would be things like days sales outstanding. One of the things that we need to look at is we continually look at our accounts receivable table in terms of who's outstanding, basically our customer list and how far they're out, and have some very specific policies to target these people that are not paying their bills. The thing that we want to make sure in terms of the credit policies should not be established by the sales department. Credit policy should be established by finance or the Treasury department, because these are the people that are responsible for ultimately all the goals within the organization, as opposed to specifically to sales. Okay, so there's some additional thing that we want to talk about, but I think we've got the bulk of what we wanted to cover in today's lecture. So in any event, this actually concludes the lecture because I think we've run out of time. So I thank everyone for their time and attention, and we will do this again in 2 weeks. And I appreciate everybody's activity, and I will get those. So I thank you very much for your time and attention. Everybody have a great evening, and we will talk in 2 weeks. Okay, thank you very much. Okay, bye-bye.